Stop. Just stop for a second. Before you make what could be the single most expensive financial mistake of your life, I need you to sit down, take a breath, and really hear what I'm about to tell you. Because right now, in this moment, as silver is pulling back and your phone is showing you a number that's lower than it was a few months ago, there are people, smart, experienced people who have been through every market cycle you can imagine, who are not selling. They are buying, and they are doing it with urgency. So before you call your dealer, before you list anything, before you do anything at all with your silver, I need to show you exactly what is happening beneath the surface of this market. Because what looks like weakness on the surface is actually something far more powerful brewing underneath. Let me paint you a picture. Earlier this year, silver crossed a threshold that the market had been flirting with for over 4 decades. It crossed $100 an ounce. You heard me right. Silver, the metal that sat in the $20 and $30 range for years, the metal that most financial planners barely acknowledged, the metal that ordinary people had tucked away in safe deposit boxes and sock drawers for decades, it cracked triple digits. And then something happened. It pulled back. It came off those highs. And right now you're watching a price in the mid-70s, and your brain is doing what human brains are wired to do in moments like this. It's telling you to get out. It's telling you the ride is over. It's whispering that maybe the smart move is to take the profit while it's still there. But here is what I want to challenge today. What if that voice in your head is dead wrong? What if selling your silver right now is the equivalent of selling Apple stock in 2003 because it fell from its early highs? What if this pullback is not the ending, but the setup for the biggest move silver has ever made? What if everything happening in the world right now, the geopolitical shifts, the industrial revolution unfolding in real time, the currency realignment that's been quietly accelerating, is pointing not to silver's ceiling, but to the floor of an entirely new chapter? I want to show you the case, not the hype, not the cheerleading, the actual layered evidence-based case for why selling your silver right now could be a decision you regret for the rest of your life. Let's start with the simple math that most people miss. Silver has gone up over 100% in the past year alone. 100%. In a world where a savings account gives you a few percent and the stock market has been churning sideways through volatility and uncertainty, silver has doubled. But here's the twist. It also hit $100 an ounce earlier this year and is now sitting in the mid-70s. So naturally, people look at that pullback and feel nervous. They feel like they missed the top, and now they're watching something unravel. But veteran commodity traders will tell you something critical about this dynamic. The first major spike in a bull market is almost never the final move. It's the announcement. It's the market saying out loud for the first time that something significant has changed. The pullback that follows is profit-taking, it's short-term traders exiting, it's the paper market doing what the paper market does. And then, when the dust settles and the real buyers step back in, the second move is typically far larger than the first. This is the pattern that played out in gold in the early 2000s. Gold hit a high, pulled back, made everyone nervous, and then went on to run for another decade. It's the pattern that played out in oil. It's the pattern that played out in virtually every major commodity that's ever experienced a secular bull market driven by structural forces rather than speculation. And that word, structural, is the most important word I'm going to use today. Because What's driving silver's price isn't traders at a desk making bets. It's physics. It's chemistry. It's the physical reality of what this metal does and why the world needs more of it every single year. Quick note, if you're watching this and you've been curious about protecting a portion of your retirement savings with precious metals, I've put together a free guide in the description below that covers the saving strategies thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free. Just check the description below. Now back to the structural story, because this is where it gets genuinely extraordinary. Silver is not just a monetary metal. It hasn't been just money for a long time. Today, roughly 60% of all silver demand comes from industrial applications. 60%. Think about that. 2/3 of the reason the world needs silver has nothing to do with jewelry or coins or investment bars. It has to do with the fact that silver is, by almost every measurable standard, the most electrically conductive metal on the planet. It's the most thermally conductive. It has natural antimicrobial properties. It reflects light better than any other element. And because of those properties, it has become utterly indispensable to the technologies that are being built right now to power the next 100 years of human civilization. Every solar panel that goes onto a rooftop, and millions are going up every single month around the world, contains silver. The photovoltaic cells that convert sunlight into electricity rely on silver paste to conduct that electricity efficiently. As solar capacity has exploded globally, and as the efficiency requirements of next-generation panels have actually increased the silver content per panel, the industrial demand side of this equation has grown in ways that the market is still struggling to fully price in. Every electric vehicle contains silver. The average electric vehicle uses somewhere in the range of 2 to 3 times more silver than a traditional combustion engine car. The wiring systems, the battery management electronics, the sensors, the charging infrastructure, silver is threaded through all of it. And the global push toward electrification of transportation is not slowing down. It's accelerating. Every major automaker on the planet is retooling entire production lines around electric vehicles. Every government is subsidizing the build-out of charging networks. Every infrastructure bill in every major economy has electric vehicle integration embedded in it, and every single one of those vehicles needs silver. Add to that the explosion of 5G infrastructure, the build-out of artificial intelligence data centers, which require extraordinary amounts of silver in their cooling systems, their circuit boards, their power management units. The medical technology sector, which increasingly relies on silver's antimicrobial properties for everything from wound dressings to surgical instruments. The defense sector, which uses silver in radar systems, missile guidance, and communications equipment. The list of industries that need silver and need more of it with each passing year is not getting shorter. It is getting longer, dramatically longer. Now here's where the picture becomes truly alarming. And I want to be careful with that word because I don't use it to create fear. I use it because the supply side of this equation warrants genuine attention. Global silver mining production has been essentially flat for years. The world's major silver mines are aging. The grades, meaning the concentration of silver in the ore being extracted, have been declining as miners have to dig deeper and process more rock to get the same amount of metal. The easy silver has been found. What remains requires more energy, more capital, more technology to extract. And despite the dramatic increase in silver prices, the supply response has been notably muted. New mines take years to develop. Environmental permitting is a multi-year process. Capital investment in mining has been constrained by years of suppressed prices that made many projects economically unviable. What this creates is a deficit, a structural, ongoing, multi-year deficit between the amount of silver the world is consuming and the amount being pulled from the ground. The Silver Institute has documented consecutive years of supply deficits, and nothing on the horizon suggests that is about to reverse. In fact, as the industrial demand drivers I just described continue to accelerate, the deficit is projected to widen. Think about what that means for a moment. You have an asset where demand is growing, driven by technologies that are essential to the energy transition and to the digital economy. You have supply that is constrained and growing slowly at best. You have a deficit that is compounding year after year, meaning the above-ground stockpiles that have historically acted as a buffer are getting depleted. And you are thinking about selling? Let's talk about the gold-to-silver ratio, because I think this is one of the most underappreciated arguments for holding silver right now. The gold-to-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. As of right now, with gold trading around $4,500 and silver around $74, the ratio sits at roughly 60 to 1. It takes about 60 ounces of silver to buy 1 ounce of gold. Now, here is the historical context that should make every silver holder sit up straight. Throughout history, across thousands of years of human civilization, the natural ratio between gold and silver in the Earth's crust is approximately 15 to 1. Silver is more abundant than gold, but not dramatically more so. For centuries, monetary systems reflected something close to that geological reality. At times of peak industrial demand and monetary stress, the ratio has collapsed to 30 to 1 or even lower. In 1980, when silver briefly touched nearly $50 an ounce, the ratio narrowed dramatically. In various periods throughout history, when silver was truly recognized as the monetary and industrial metal it is, the ratio reflected fair value. At 60 to 1, silver is dramatically undervalued relative to gold. If the ratio were to normalize to 40 to 1, not the historical extreme, just a moderate normalization, and gold stayed exactly where it is today, silver would need to be over $100 an ounce. If it normalized to 30 to 1, silver would need to be around $150. These aren't wild fantasies. These are simple arithmetic expressions of what a historical normalization would look like. And here's what makes this even more compelling. Gold itself is not done moving. Goldman Sachs, not a fringe newsletter, not a conspiracy blog, but one of the most powerful financial institutions on the planet, has been projecting gold targets in the $5,000, $6,000 range and beyond. J.P. Morgan has made similar projections. The World Gold Council has pointed to central bank accumulation patterns and de-dollarization trends as structural tailwinds that suggest gold's run is far from over. If gold continues to move higher, and if the silver-to-gold ratio normalizes even partially, the arithmetic for silver becomes genuinely breathtaking. Let me take you back to 1971 for a moment, because history has a way of rhyming that makes the present far more readable if you understand the past. In August of 1971, President Nixon appeared on television and made an announcement that most Americans didn't fully understand at the time. He said the United States would no longer allow foreign governments to exchange their dollars for gold. In one speech, he severed the last formal link between the U.S. dollar and precious metals. The Bretton Woods system, the global monetary architecture that had governed international finance since the end of World War II, was gone. At first, the market shrugged. Stocks barely moved. Most people went about their lives. But what happened over the following decade was one of the most dramatic wealth transfers in modern history. Inflation exploded. Gold went from $35 an ounce to over $800. Silver went from around $1.50 an ounce to nearly $50, a 3,000% move. The people who had held precious metals through the initial confusion and uncertainty didn't just preserve their wealth. They multiplied it in ways that no other asset class even came close to matching. Now, I'm not saying history will repeat exactly. History rarely repeats exactly. But the forces that drove that explosion in the 1970s, currency debasement, loss of confidence in monetary institutions, runaway inflation, geopolitical instability, are present today in ways that are at minimum comparable and arguably more intense. The dollar's status as the world reserve currency, the foundation of global finance for 8 decades, is facing its most serious challenge since Bretton Woods. The BRICS coalition, which now represents a substantial portion of the global economy and global population, has been actively building alternative payment systems, alternative settlement mechanisms, alternative trade arrangements that reduce dependence on the dollar. Russia and China have been settling energy trades in currencies other than dollars. Saudi Arabia has been discussing accepting payments for oil in currencies other than dollars. The petrodollar system, the arrangement that has underpinned dollar dominance since the 1970s, is showing cracks that no serious analyst can ignore. Central banks in the developing world have been buying gold at a pace not seen since the 1970s. The official sector purchases that the World Gold Council tracks have shown consecutive years of historically elevated buying. And when central banks, the institutions that create money, are choosing to accumulate hard assets rather than hold more of each other's paper currency, that is a signal worth paying extraordinary attention to. When fiat currency systems come under stress, precious metals have always been where value seeks refuge. Every time in history, without exception, and silver, because of its dual role as both a monetary metal and an industrial one, has historically amplified gold's moves. When gold runs, silver tends to run farther and faster, precisely because it has both the safe haven bid and the industrial demand bid working simultaneously. Let me tell you about 2008, because a lot of people remember silver crashing during the financial crisis, and they use it as a reason to doubt silver's long-term resilience. And yes, silver absolutely cratered in 2008. When the financial crisis hit and forced liquidation swept through every asset class, silver was not spared. It went from about $20 down to about $8 in a matter of months. People who watched that happen said silver was unreliable. Silver was too volatile. Silver wasn't a safe haven after all. And then something happened. The Federal Reserve launched quantitative easing. The government printed trillions of dollars to bail out the banking system. And silver, which had been crushed in the panic, didn't just recover. It exploded. By the spring of 2011, silver had gone from $8 to nearly $50. From the crash lows to the 2011 peak, silver delivered roughly a 500% gain in under 3 years. The people who had panicked and sold at $8 told themselves they'd been vindicated by the initial crash. But they missed one of the greatest precious metals runs in history. The lesson isn't that silver never goes down. It does. Sometimes violently. The lesson is that the pullbacks in a secular bull market are not exits. They are entries. They are the market offering you another chance to participate in something that the long-term forces have already decided is going higher. Now let me bring this back to right now. Because everything I've described, the industrial demand explosion, the supply deficit, the currency system under strain, the gold-to-silver ratio at extremes, the central bank behavior, the geopolitical realignment, all of it is present simultaneously. You rarely get one of these factors at work. Having all of them aligned together simultaneously is genuinely unusual. And what that suggests is not that we're at the end of a silver bull market. It suggests we may be in the early innings. The $100 price silver hit earlier this year wasn't some random speculative frenzy. It was the market beginning to price in these realities. The pullback to the 70s is the market catching its breath, shaking out weak hands, setting up for what comes next. And what comes next, if the structural forces I've described play out anywhere close to what the data suggests, is a price environment for silver that makes what we've already seen look modest. And look, I want to be real with you for a second. I know some of you watching this are thinking about your retirement. You're thinking about everything you worked for over decades. You're wondering whether the systems you've been told to trust, the stock market, the bond market, the dollar itself, are as reliable as they once seemed. And honestly, those questions are not paranoid. They're prudent. The world has changed in ways that make financial resilience more important than ever before. If you have $100,000 or more sitting in a retirement account, a 401k, an IRA, a pension rollover, and you haven't looked at how to get physical gold or silver working inside that account, it might be worth your time. There are ways to do this that are completely legal, tax-advantaged, and don't require you to liquidate anything you don't want to liquidate. I've helped people understand these options, and the guide in the description is a good starting point. It walks through how this works, what the rules are, and what questions to ask. No obligation, just information. Worth reading if this is relevant to your situation. Now, where is silver headed from here? Let me give you the honest picture. J.P. Morgan, which is one of the most active players in the silver market, both as a trader and as a custodian of the largest silver ETF in the world, has projected an average price for silver this year that is meaningfully higher than where we sit right now. Goldman Sachs has been constructive on precious metals broadly. Analysts who follow the Silver Institute's supply-demand data closely have been projecting continued deficits.